Hey guys, it's Joe Gardner here of Profy Finance and Wealth. I'm a licensed financial advisor, and today I want to share with you some tips to avoid some of the common traps that you might find around your super. Now, you've got to look after your super because it's the thing that sets you up for retirement. So you want to make sure that you're constantly engaged with it, you're not losing sight of it, and therefore you're making sure that it's there for you and ticking away properly. Let me take you through some of the traps to avoid, just so you can keep things working away for you properly. The first one is fees. You need to keep an eye on the fees that you're paying in your super account, especially as it relates to like a portion of your balance. You don't want to be paying a lot more than 1.5 to 2% in fees. Anything above that is starting to get a bit pricey for managing your super, okay? So number one, fees. Number two is watch out for people telling you that a self-managed super fund is automatically the best thing to go into. Chances are it's not, okay? We've had a lot of growth in the SMSF space, and while that can be a fantastic option for people with higher balances, and typically we're looking at 100, 150 and 200 plus, if you're not currently at those balances, or if you don't have the investment background and compliance background that an SMSF basically needs you to stay on top of, then an SMSF is probably a bit too high touch. It's probably going to have more costs that is worth it for you to enter into. So just keep an eye on that. If you don't have the confidence behind your investments, you're not confident in your advisor, or you have a low balance, just make sure that an SMSF isn't something that you get pushed into, okay? It could be a good option later for you, but just make sure that the time is right. Next is watch out for any spruikers that are trying to say, set up an SMSF and then put this off the plan property in it. That's usually not the way to go. You don't want to be missold one of those things and be caught on the end of some dodgy developer who has some off the plan property which is overvalued and you can't get the value agreed by the bank. There are horror stories like that happen like that all the time. Okay, so it's not a good idea to go and chuck SMSFs with properties in them as a default option, okay? So just make sure that you're especially careful around there. Now, number four, advisor fees. An advisor may have signed you up at your workplace and then pretty much like wham bam, thank you ma'am, and just walked away and not added any value to you after that. So this often happens because they prey on the fact that you're not engaged with your super, therefore they're going to keep deducting fees out of your account. Now, unless you're getting unless you're getting value from that advisor, you shouldn't be giving money to that advisor. You want to go with an advisor that's actually actively helping you, checking in with you, making sure your investments are still appropriate for you. So if you haven't heard from your advisor in more than a year, but you still see on your super statement that you're being charged advice fees, well then cut it out. Get in touch with the super fund. Make sure that that stuff stops because that's costing you money. Tip number five, you need to be consolidated with your funds. This is pretty much just like paying account keeping fees all over the place. You know, it's as if you've got 3 different bank accounts and you're paying fees in each spot. Make sure you're just paying fees in one spot, and again, make sure that they're reasonable fees. Back to point number one. It makes sense. Just bring them all together. Choose an investment manager that makes sense for you to be with. If that's an industry fund, great. If that's a self-managed super fund, great. If it's an AMP or a BT, okay, great, but make sure it's consolidated. Next is your insurance settings. Insurance often gets added into our super and that's designed to protect us, okay? But your insurance settings could get quickly out of date because maybe you've got a higher income now. Maybe you've married and had children. You could have taken on some debt, for instance, for a house. Those are the types of trigger points that mean that you should be looking to review your insurance and make sure it's up to date for you and serving you properly. You also want to fine tune it to make sure it's the most cost-effective option. Similar to how you don't want to be paying excess super fees, you don't want to be paying excess insurance fees. You want to make sure that they're good value. Okay. Reason number 7, or thing number 7 to avoid is not putting enough into super. You can just chug by with your current contributions from your employer. They're currently set at 9.5% of your gross package of salary. However, it's a good thing to be putting in more into your super, particularly if you're a corporate professional or a high income professional. There should be plenty of headroom in your budget to put in an extra $200 a week, $50 a week, whatever. Just start there and make sure you're putting some extra in. It's called a salary sacrifice arrangement, and you can salary sacrifice up to $30,000 per year when you're in your prime career years. So make sure that you're working to salary sacrifice and put in stuff early on, because as you get your snowball built and rolling that snowball early on in life, that'll then keep rolling for you in the later years, and you build up a much bigger balance, okay? Just by the virtue of starting early. So that's a vitally important thing. Next, a super trap to avoid is not setting up a transition to retirement pension. These can be fantastically tax efficient. So if you are approaching the pre-retirement period, basically if you're in your 50s, maybe early to mid 50s, you need to maybe start planning for when you can access that transition to retirement pension and get some planning advice about when to put it in place. It's going to be a really key money saver. It's going to do two things for you. It's going to boost your tax position and make it more efficient, and it's going to add into your super balance. So 2 key reasons for you to look at that strategy. Number 9, with regards to your super, especially if you do have an SMSF, you don't want to be investing in speculative shares. Just avoid that totally. You want to be going with companies with a proven track record. If you are selecting growth companies, make sure that they don't take up the bulk of your portfolio. And of course, where do you go for advice? I don't think you want to be going to stock forums like Hot Copper and reading all the rumors. All right, so you want to be making sure that you're going with companies of a decent market capitalization, decent liquidity, the right fundamentals, and that reduces your risks that you're taking. Super traps to avoid, number 10 is any schemes, okay? You don't want to be exposing yourself to any tax avoidance schemes, any property schemes, anything that's alternative, okay? They're typically not going to work out very well for you. You're exposing yourself usually to people who are there to make a quick buck and then pull out. You want to be working with an advisor who views you as a long-term client and is going to be sticking around for 20, 30 years so they can guide you through a long-term approach. So watch out and totally avoid getting into any schemes, especially within super. But look, that most definitely applies to stuff that you're doing outside of super. So if you're tempted to click on that ad on Facebook around wealth creation or go along to that seminar, just make sure to check out the credentials on the asic.gov.au website. Are they a licensed financial provider? Are they licensed in mortgage broking? Are they licensed in financial planning? Or are they just an education provider? That's lingo for I'm telling you to do stuff with money, but I'm not regulated. So that's a very grey area, and you don't want to be getting so-called education advice from those guys. Lastly, poor performance. A super trap to avoid here is just make sure that you're reviewing your super fund, not only for their fee position to make sure that they're good value, but also have a look at the performance of the fund. If they're only ranking in the lower quartiles or lower half of the performance in the market, you need to be shifting to a fund that's more well managed so that you can get that investment performance that you're looking for. Because every year that you have a poor return means that your snowball is starting to melt. It's starting to reduce its effectiveness, okay, for you. So guys, there's 11 key tips on how to avoid some traps in super, get some better things underway for you. They're really useful insights in which to build a much more effective plan for your retirement. So guys, thanks for joining me on the video. Look out for plenty more, and if you need a hand implementing these, of course, look us up. We're Profy Finance and Wealth, and we're here to help you to get set up for your financial future.